Afternoon to all of you. I am Dr. Sanjeeb Pattnaik. I will be taking your session now uh, in the particular course which has been coded as MMPF 007, that is the equity markets. Now, this course has been divided into four blocks. Uh, we In this particular session, we shall be going into block 2, where in unit 4, we shall see issue management. Now, already we have seen in the previous blocks, that means block 1, which covered the basics of the markets and the various type of instruments that are available in the market along with their characteristics and the players also. Now in this block 2 we are looking at the primary market, that means the basic market where issues of either existing companies or new companies are floated for the first time. When we say first time, that means new issues. So new issues of new companies are either also the existing companies. When we try to issue it, the place is called as the primary market. Now in this particular unit today, that is unit 4, we shall see the issue management. That means when an organization or a firm or a company is going for a certain issue or floating the shares, how it tries to manage the shares. Now when we try to say that we are floating an issue or going for a fresh issue or new issue, that means what? We are offering the shares to the general public. Particularly, we can also segregate that into to the potential investors. Now, why the term management is included there? Now, all issues may not be successful. In order that a issue is successful, we have to go through a certain managerial process. Now, when we say issue management, we try to say what are the methods, the ways in which we shall approach an issue to make it a successful one. So, today we shall concentrate on issue management. Now, here the issue management, also we try to say the term merchant banking are used interchangeably. That means either you can say issue management, which is done by a particular organization, or in other words, the organization which manages an issue of a firm is called as the merchant bankers. Now, what do the merchant bankers do? Now, the merchant bankers advise the organization on the market driven factors. Because when you try to have a issue, that means offering your securities to the potential investors, various factors come into the picture. We can say among the factors we have the size and timing of public offerings. For example, what should be the issue size? That means how many securities we shall be issuing. Now, if the issue size is too large, then automatically it may lead to the issue may not be subscribed, or the potential investor may not be able to buy all the securities. Similarly, the timing. Now, markets or the potential investor in general in an economy can harm sentiments or mood swings, and which is infectious. Infectious in sense, if certain people do a work in a certain way, we also try to do it in the same way. We try to follow them. So the market moves and drags most of the investor in that particular way. Either it can go upward, that means market is booming, or the prices of the shares will be going upwards, or the markets will be coming down. That means facing a recession. In other words, we may also say that the thing is done by certain investor which has been followed by large masses of investors. Similarly, the capital structure. When we say capital structure, we mean that what is the proportion of debt capital and equity capital in general in the total capital for an organization. By capital, we mean the investment, how much we have invested in an organization. That can either come from the owners, that means through equity capital comprising of equity shares and preference shares. Similarly, a portion or the remaining portion can come from the debt capital. Now, the debt capital can be in the form of loans, the loans of different forms like machinery loans, working capital loans, etc. We can have securities like bonds, debentures, etc., which will be providing us capital but in the loan format. Now, what should be the proportion maintained for an organization's capital structure so that it will make it attractive for the potential investors to invest in your company? Similarly, another factor can be the type of issue. That means whether the issue is a new issue or additional issue. Now, when we say new issue, we say the shares are floated for the first time. Any organization, when it prepares its memorandum of association MOA, it tries to keep a certain view of the capital that it will be having in the organization. That is called as the authorized capital. Now, suppose the authorized capital of an organization is rupees 100. The company may not go for issuing securities worth of authorized capital that is 100. It can go for phase-wise manner for issuing the equity shares. Suppose 30% of the authorized capital will be issued to the general public. So we say we are issuing new capital out of the authorized capital to the potential investor. Similarly, a company which is already existing, that means it is having its equity shares up to certain extent of the authorized capital, it may require additional funds for its various needs. So in that case, the company may go for additional funds through the shares or the equity shares. So thereby, what it will do? The company, out of the remaining portion of the authorized capital, apart from the existing shareholders, it will again a portion of that will be issued to the potential investors. Similarly, bonus. The name itself bonus, when the company has huge amount of reserves that have been kept back as retained earnings, it may sometimes issue bonus shares. So this bonus shares will form a part of a gift to the loyalty shown by the shareholders. Similarly, rights issue. Now, whenever an organization is going for fresh issue, that means existing shareholders are there, but further fresh issues are being done in the market or to the potential investor. First is it is offered to the existing shareholders as their primary right. They have the right to either purchase those equity shares at a price fixed by the organization, and this is usually less than the market price, or you can combine anything. Now, what does the merchant banker do? The merchant banker is responsible for planning, coordinating, and overseeing the issue activity so that the issue that the company has gone for is a successful one. That means the equity shares have been taken up or mopped up by the potential investors, and through that the required capital has flown to the, or it has flowed to the company's investment. Also, it trains, that means the merchant banker trains other agencies like underwriters, brokers, bankers, advertising agencies, auditors, legal advisors, etc. Now, as we shall move on, we shall see underwriters are certain agencies which guarantee that the issue is a successful one. Similarly, you have brokers, the bankers, etc., who will be helping in the issuance activity. Now, all these activities comes under the purview of certain rules and regulations. In India, SEBI establishes guidelines for issue management. Now, an organization can raise funds either through public issue, right issue, and private placement. As we move on, we shall see what are these three. First, we talked about raising funds through public issue. The name itself, it is offered to the general public at large. So, offerings to general public for raising funds, that means the offerings are in the form of equity share, is called as public issue. All the general public, that means the potential investor, they can look at the company, its future prospects, or its existing background, and they may or may not decide to go for the purchase of this particular issue. What the firm does? Now, the firm uses a certain document called as prospectus. Now, all of us have seen prospectus of many other organizations, or simply we can say prospectus of a school, prospectus of a college, prospectus of a suppose paint company, etc., etc. Suppose let us pick up the example of a school prospectus. What it tries to show? Now the background of this school. What is the future of the school? So all kind of information will be crammed into this particular prospectus about the organization. So prospectus provides information about the company and the number of shares to be issued. Who formulates the guideline? Na SEBI, Securities and Exchange Board of India. Now here for the public we have two kind of issues. One is IPOs, which many of us might have seen in the newspapers, etc., or we have heard about or seen in the electronic media like news channels, etc., and also the follow on public offer, FPO. What is initial public offer? Now, whatever is the number of shares that has been decided to be offered out of the authorized capital in form of equity share is called as initial public offer. Suppose we find the initial public offer is a huge success due to track record of the company and the possibility of the company's big or better future aspects, people may demand more number of shares. But since we have taken the permission from SEBI for issuing certain number of shares, then we have to give those shares to the investor on a proportionate basis. So what will happen? Many of the shareholders may be deprived from getting the shares of this particular company. So when this is the kind of scenario, the company may come up with follow-on public offer. That means apart from the public offer it has done, some additional public offer it may take permission and issue to the potential investors. What are the benefits and drawbacks of a public issue? Now the benefits of a public issue is once the money comes in, the money usually comes in the form of application money. Suppose the equity share is to be floated or received at a price of rupees 100 per share. Now this 100 rupees that is to be generated from the potential investor so that he or she becomes a shareholder, it has been divided into various parts. First is one has to apply for the particular equity share by giving some portion of money. Suppose we say rupees 10 is the application money. So one applies by paying rupees 100 to the company, rupees 10 to the company. Another 90 rupees are still there to be received so that the share will be fully belonging to the particular equity share holder. Now, any shareholder who has paid application money of rupees 10 and becomes eligible or is allotted the equity shares, then the remaining amount has to be paid by the equity shareholder. Now we are saying the potential investor as the shareholder because he or she has been allotted the equity shares. Once the potential investor becomes the shareholder, the money is non-refundable. Now, on the equity shares, we pay some returns either to the shareholders, or we may also have the right to hold back those returns in the form of internal accruals for future requirement of the company. So, whatever we pay to the shareholders or declare to pay to the shareholders out of the years, the financial years, profit and loss, that we call as dividends. Now, these dividends may be paid or may not be paid to the equity shareholders. So, we say dividends do not put financial strains. Now, shareholders' value increases. If we have internal accruals, etc., or every year profit is increasing, then we may say the company's work is being accepted in the market and the company has very good future prospect. Now, when this happens, the share is having a growing demand in the marketplace. When the demand grows, we know that it will also drive the price upwards. In other words, shareholders' value increases. Now, in order that a company goes for IPO, initial public offering, the trading and listing in the stock exchanges have to be done. That means all the trading activity has to be done in the stock exchanges, and for that, a process called listing or the company's equity shares have to be listed in the stock exchange. Now, this public issue in the form of equity shares provide liquidity in the form of investors' hand. The investor at any point of time can sell off their equity shares which they have got through public issue so that they can have their money in hand. But this public issue has certain drawbacks. The public issue is a time consuming process. And not only that, in order that a public issue becomes a successful one, the company has to do many activities so as to catch the attention of the investors. So, activities like advertisement, road shows, etc., which builds up to the public issue, it has some cost attached. So that is why we say public issue is expensive. Now, through this public issue, certain individuals or companies may mop up the equity shares and increase their stakeholding in the company. Thereby, if their stakeholding or the stakes are higher in the company's shareholding pattern, they can take over the company's directorship. They can take up the company into their folds. So chances of takeover is there. Now, public issue includes larger number of intermediaries like merchant bankers, underwriters, banks, financial advisors, uh, depositories, the stock exchanges, etc. And for a public issue, the company requires transparency, not only in its activities, that means the process of generating output, but also in the financial activities. So, this may lead to loss of privacy of the company. And the public issue, while a company is going for, it has to adhere to the regulations. What are the factors for success of a public issue? Now, first is tracking investors' mindset. We can look at what is the pattern of mindset that is happening in the investors by tracking the stock indexes like BSE Sensex, like Nifty, etc. in India. So their upward movement means that investors are having demand of the equity shares. So thereby it may be a convenient time to go for IPOs. Second is we have to advertise in such a way that it will catch the people's mind and draw them towards the company's investment. Third is target market. Now, whom are you targeting? Is it the general public all over spread all over India, or some investors located in particular belts or pockets across India? Is it young masses having disposable income in their hands, or the old masses who have larger disposable income in their hand as compared to young masses? Similarly, you have to look for appropriate timing for your public issue. And you can always go for consultation with potential investors before going for public issue. That what is their requirement, what the company is trying to offer, at what price and at what time. All these things combined together will make a public issue a successful one. Now, when we go for a public issue, what should be the price of the equity shares? Now, here we say it should be unrestricted pricing. That means, according to the demand in the marketplace, when the equity shares are floated, the prices will be market driven. Now, the pricing differs for farm allocation and public issue. So, when you are offering a large portion of your issue to a certain organization or financial institution as farm allocation, you should have a different price as compared to the public issue pricing. And when you are offering rights issue, that means to the existing shareholder, you have to offer the issue first. It should be lower than the market price, so that the existing shareholders may take up the equity shares and keep their shareholding pattern in the organization, or their shareholding stake in the organization as before. And usually company do what? Now they fix a 20% price band. That means they will try to say the price is fixed at rupees, suppose 500 rupees. They will form a 20% band around the 500 rupees, which will be the price of the equity share. If it falls below it, they will not offer the shares. If it goes beyond that 50% price band also, a 20% price band, that may also adversely affect the organization. Next, let us look at rights issue. Already we have spoken about rights issue as offering of the issue to the existing shareholders of the organization before it is offered to the outside potential investors. So, it is an opportunity for existing shareholders to purchase additional new shares. So, as an existing shareholder, I have the right to go for the issue first. The existing shareholder can purchase the new share by using their rights. Just now we said we can utilize our rights as existing shareholders of the company and we can purchase the new shares. And at what price? Just now we discussed that yes, the prices of the rights issue should be lower than the market price that is prevailing in the stock exchanges or the markets, so that the existing shareholder are inclined towards purchasing the rights issue. Now, what are the advantages and disadvantages of rights issue? Now, when we go for rights issue or the rights issue during an issue, it is a very fast way of money raising because you don't have to go through lot of hassles. You don't have to go for lot of advertisements or time consuming process. So it is a fast way of money raising and it is affordable. Why? Because many costs which may have been incurred to have large number of intermediaries as well as we can say expenses in the form of advertisement, etc., that doesn't arises. So it is affordable. It helps the existing shareholders to maintain their proportion of ownership in the company. So if the existing shareholders take up the issue, that means purchase the issue or received shares, then the ownership proportion is also maintained. Now, this also helps the company to avoid inclining towards debt financing, which may be more risky for the companies in times of difficulty like less profit or no profit. Disadvantages: it lowers the shareholding ratio. Now, as the number of shares increases in the capital structure of the company, the shareholding ratio may come down. Since it is offered at a lower price than the market price, it may lower the share prices in the market because a particular shareholder, suppose existing shareholder, it purchases the uh, rights issue or the issue through their own rights at a lower price than the market, and they can sell up the equity shares which they have got through these rights at still a lower price than the market price. So thereby what will be happening? Now the share prices will be coming down in the marketplace. And this may also lead to companies' unfavorable reputation. Now, the third way of raising funds or issue is private placement. Look here, the placement is issuing the shares privately. To whom? Not to certain privileged financial institutions or individuals by the company. So it is direct sale of securities to individual investors who are of high net worth. When I say high net worth, that means their wealth proportion is very, very high. So company, if it feels that we shall sell the securities directly to the individual investor, then it is known as private placement. Here, no requirement of preparing the prospectus, and instead of going for the public offering, we can go for the private placement. It is open to wealthy individuals, banks, financial institutions, mutual funds, insurance companies, or big organizations, also government organizations. Now, what are the advantages and disadvantages of this private placement? The advantages may be when the company has been set up just few years it has been operating. So in the initial periods, it may be suitable for the company because public may not be knowing about the company which is operating for a few years only. That means it is beginning to be growing up. Second is adaptability. Now, when the financial institution etc. take up in masses the equity shares, that will give an adaptability for the company. Now, companies also have an option for selecting partner through either the wealthy individuals or the banks or the financial institutions, etc. When we are talking of disadvantages, it is difficult to identify potential investors. Since we are not offering this kind of issue, that means the private placement issue, to the general public in open, so we do not know who are our potential investors because we are taking a selective group of investors into our fold, and it will be a very small market as compared to the IPOs where the whole of the economy is the marketplace. Let us see what are the activities involved in an issue. Before an issue takes place, what are the pre-issuance activities? First is due diligence of merchant banker. Now from onwards, we have represented as MB. Now due diligence, that means the particular financial organization who is called as merchant banker who will be doing the issue management will have the due diligence certificate. That means it is complying to the regulations as per the SEBI guidelines. It has a track record of not entering into fraudulent practices, etc., etc. Now, before the issue commences, we have to deposit certain kind of fees in order to file the draft documents with the authorities. Now, where from the fees will come? Now, it will be arranged by the merchant banker. Now, the MOU, the Memorandum of Understanding between the merchant banker and the firm regarding that the merchant banker will be taking up the issue management for the organization, particular organization. The agreement or the memorandum of understanding should be submitted to SEBI, Securities and Exchange Board of India. Now, which organization will be doing the underwriting thing? Now, what is underwriting? For an issue to be successful, a certain minimum proportion of the issue should be taken up by the public. Suppose, let us say that in order that a issue to be successful, 90% of the issued securities should be picked up by the general public, or 90% of the equity share at least should be taken up by the potential investors. Suppose a particular issue that we have gone for is only taken up to the extent of 50% by the various potential investors. It may be individuals, it may be financial institutions, banks, etc. etc. In that case, what will be happening? Now, since it is not touching the minimum level at least required for the successful or success of an issue, that is 90%, the issue may be declared that it has failed. So what can we do? So the merchant banker here will appoint a particular financial institution that in such a case, the remaining portion which has been not subscribed by the potential investor will be picked up by the underwriters or the financial institution, which will be taking up the remaining 40% of the issue, so that the total subscription for the issue touches the 90 mark or the minimum level at least, so that it is counted as a successful issue. So these underwriters do this activity for a certain amount of fees. So who is the underwriter to the issue? That will be submitted or informed by the merchant banker to Securities and Exchange Board of India, SEBI. The due diligence certificate should be submitted to SEBI, where, as we said, that all suggestions by SEBI has been adhered in the prospectus. Whatever SEBI has prescribed, directed, all things have to be incorporated in the prospectus. You cannot deviate from that. This due diligence certificate should also be submitted to the registrar of companies. Now, for follow-up public offers, FPOs, disclosure certificate should be submitted by the merchant banker. Also, an undertaking by the merchant banker regarding the promoter's part in the issue. That means how much maximum a promoter can take up from the issue. Details of the promoters or the persons behind floating the company or setting up the company should be provided. Now to the SEBI, what are the things we try to submit? Now in this pre-issuance, first is fixed price issue. That means whatever is the issued securities, the price for that is already fixed by the company and it will be submitted to Securities and Exchange Board of India, SEBI. So draft offer document along with prospectus should be submitted to SEBI. If it is not a fixed price issue, you are trying to mop up a frame of demand in the mind of the potential investors, we say that we go for book building issue. What is it? Now first we prepare a red herring prospectus, the price band, the issue size, how the bidding will be taking place, and offer documents along with the final prospectus. All these things should be done to motivate the potential investor to have a demand for the coming up initial public offer, IPO. Similarly, for the follow-on public offer, the offer document should be submitted to SEBI. Also, this is done for rights issue, and for private placement, we try to divide the institutions to whom the issue will be given on a bulk basis as the preferential categories and the qualified institutional placement category. So when it is preferential category, we directly go to them and offer our issues. But if it is qualified institutional placement, what we do there, that whoever have qualified according to our requirements, they will be offered to buy in bulk the issue. Now, then we prepare an appraisal note by the external agency. That means the previous things that we have seen, whether they are adopted by the merchant banker and it has been complied to the various legal authorities like SEBI, like Registrar of Companies, etc., that a appraisal is done not by any kind of internal agency but by the external agency. Intermediaries, those who have been appointed like underwriters, the registrars to the issue, that means the registrar are those who try to keep the records of the investors to whom the equity shares are allotted. Similarly, we go for grading of issues. The issues, what category they are falling in. Sometimes we say it is just similar to ranking. Whether the rank is better or rank is bad, it is done by the independent credit rating agencies. Then the draft offer document should be submitted to the SEBI and as well as the stock exchange where it is to be listed. Then we go for a depository who will be the custodian of the equity shares in the electronic format for the investors. Then we go for pre-issue advertisement in order to build up a demand in the potential investors' minds. Now, pricing of equity issues through book building process. Now, pricing we can have differential pricing, the price bands, the fixed price, and the face value also. When we look at book building process, we appoint a lead manager, the same thing as or the same as merchant banker. Then this merchant banker prepares and submits the draft prospectus to SEBI. After SEBI approves the draft prospectus, a specified price band is prepared. Invitation for quotes are also done. IPO advertisement is done. Restrictions on allotment, that means if allotment is done to a particular organization or particular group of individuals, then the chances of takeover of the company may be there. Then final prospectus, which is approved by SEBI, will be submitted to Registrar of Companies (ROC). Then the placement portion opens for subscription. That means all potential investor may subscribe or can go for subscribing the issue. All the above thing should be closed or the closure of the above a day before IPO is done. Now after the IPO comes the distribution, allocation and listing. When we say distribution of IPO, after that we go for allocation and listing in the stock exchanges. We find minimum offer to the public. How much equity shares we are offering to the general public. Then there should be a monitoring agency who will be looking after all the activities during the IPO. Then in case of allotment, that means if the subscription is more than the number of securities that has been issued by an organization, then the allotment is done on a we can say proportionate basis or pro rata basis, so that everyone who has subscribed will get in a particular ratio the shares allotted to them. Now this allotment, when it is done, money has to be taken from the investors, and if money has already been taken from investors and they do not get that many shares, it has to be refunded along with interests. Then the securities have to be distributed. Nowadays or today, we can say the securities are maintained with the appointed depositories in electronic format, because in Indian economy the securities have been converted into demat format, or in other words dematerialization format. Now, whether there are any kind of reservation on competitive basis, like private placement, etc. Now, what is the allocation in net offer to the public? Now, out of the net offer, we can say that some portion can go for private placement, some will be mopped up by the rights issue. So, how much is allotted to the general public in the form of the issue? After this is done, we go for the listing process. That means getting ourselves registered with a stock exchange so that our secondary transaction activities like buying and selling of the shares already that has been issued can be done, and it can be done only through recognized stock exchange where the organization is listed. Now, the listing process consists of closure of subscription. After subscription, we can go for listing process. We have to apprise the confirmation of allotment of securities. That means securities have already been allotted to the investors who have been selected. An auditor or company secretary will provide the certificate regarding the financial regularities. Various fees, category wise distinctive numbers should be listed, and it will be given to the recognized stock exchange. And the organization CEO will provide a statement signed, and it will be given to the stock exchange. Green shoe option is also provided while going for an issue. What is it? Now, when an organization finds that it has excess demand in the marketplace for its equity shares, suppose it has issued 1 lakh number of equity shares in the marketplace. But looking at the demand, the company thinks if I issue more number of shares along with this particular IPO of 1 lakh shares, my shares will also be taken up by the potential investors. So this is called as green shoe option. So allocating shares in excess of the public issue. So this is limited to a maximum of 15% of the issue size. So we can go for additional 15,000 shares because we have issued originally 1 lakh equity shares. But it requires the existing shareholders authorization that the company can go for this or not. In other words, legally we call it as over allotment option. It is possible only if demand requires such an action after listing. And here market maker or the financial institute plays a great role. Then we have application supported by blocked amount, ASBA. What happens? Application containing an authorization to block the application money in their bank account for subscribing to an issue. Now here the potential investor will authorize the designated banker of the issue that they can block the money in their account for the application money while subscribing to an issue. If the application is selected for allotment, then only the amount will be demanded. Otherwise, the blockage that has been done will be taken out. So this is done by self-certified syndicate bank, SCSB. Other intermediaries we can say are underwriters, bankers to the issue, brokers, registrars, portfolio managers, etc. Now with this, we'll conclude our session today. Thank you.